They have a traditional long-term care policy, and you can add a return of premium.
I'm a huge fan of the hybrid plans.
Your life insurance never changes.
Hey, I'm Drew Nichols with LTC Tree, and I'm here with my cousin and business partner, Derek Wilkins. Hey, Derek, how's it going today?
Hey, I'm good, Drew. Good to see you, man. How are you?
Good, good. So we realized that one of the number one landing pages on our website is people that are searching for information on return of premium around long-term care plans. Now, on the page, we've got a wealth of information, but we wanted to make a quick YouTube video to kind of walk through, update some of the assumptions around return of premium, and just kind of help people reason about whether they should add something like this to their policy, whether they should do a hybrid plan, what all the options are. So, just a quick background about us. We have sold literally thousands of long-term care insurance plans over 25 years. And we're recording this in the year 2025, summer, and we've got some great options for people. So let's jump right in. I guess the first thing is, why would someone even consider return of premium? Like, what's the fear there?
I think it's of missing out. And in this case, the fear of missing out is you paid these premiums all those years and then you miss the opportunity to use your policy. So that's really the driving crux of it. The other variable that I hear a lot from consumers is, especially if it's a traditional long-term care policy, those premiums can be increased. So if you have a return of premium rider on your policy, at least if you do, at least you know that if you do get a rate increase, they're going to give you the money back if you never use it.
Exactly. Now, the statistics are assuming you make it to age 65, 70% of people will need long-term care. But I think, like you say, there's that fear of missing out, that you're going to be in that 30% of people who bought this insurance, lived a long, healthy life, paid a ton of premiums in, and got nothing out of it. And it's actually a pretty rational fear, I would say. So that's why return of premium is an option. Now, let's talk about a couple of the different ways. Like, let's get tactical here. You can add a rider on a policy, or what are we suggesting these days instead of adding a rider on a traditional long-term care plan?
Yeah, there's really, in my opinion, just one company out there where it's at least worth consideration. It's Thrivent Financial. They have a traditional long-term care policy, and you can add a return of premium. Now, it only, and I say only, it adds only about 40 to 50% of the cost of the premium, but there's a 10-year catch on it. So if you die within the first 10 years, it's not going to return the premium. But for people who are buying this, our average client is 56 years old. Statistically, I'd take that risk if you do want the return of premium rider on it, because there are, I think Omaha has one, National Guardian, but we're talking about like 100%, 120% more than the premium. And that's when you're just getting really expensive life insurance. So we're moving a lot of those clients to 10-pay hybrid life long-term care plans where it's a bit more premium, but it's paid off in 10 years and they can't raise the rates either.
Yeah, I'm a huge fan of the hybrid plans if someone can afford it. And
Yeah.
usually we say for that type of plan, even if your assets are probably, let's say, over $100,000, but comfortably over $250,000, and then your dollar cost averaging using income perhaps over those 10 years, it's a potentially a suitable product. And if you have $500,000 and above in net worth, you might look at a single premium hybrid where you can knock it out with, like, say, 100K and be done. And then let's just talk about kind of like, let's just use that $100,000 option. I've made this little chart that will show. Let's just give kind of like a generic example of if someone puts in $100,000 into a hybrid, how does that sort of play out? And this is just an example that is not
Yeah.
specific
So,
to anything.
say you're in mid 50s, single male, you put $100,000 in, it's immediately from day one going to give you a leverage of 3 to 500%. So that means from day one, you'll have $300,000 to $500,000 of long-term care insurance benefits if you needed care tomorrow. The life insurance is probably going to pay anywhere from $120,000 if you don't use it, up to $175,000. So your family's not going to get rich on it, but that's really the value proposition. Now, over time, obviously, you're not going to use this statistically till 85 years old. Your life insurance never changes. It's just going to stay a fixed premium. Your long-term care benefits, that $300,000 to $500,000 is going to grow 3% compounded over time. Now, I know there's a big variance between 3 and 500,000, but that's really going to depend on the person's age, the state they're in, their gender, are they married, single?
Their
But it's
health.
probably going to be 3 to 5x on what you put in to start with for the long-term care insurance.
Yeah, and I always point out, I'll say it again, the growth on those long-term care benefits is tax-free. So what you end up with is you put in $100,000, you can ultimately make a claim that could easily be $1 million later in life. You've had $900,000 of growth. If you had invested your own money, you'd be paying capital gains on $900,000 worth of capital gains. These insurance benefits, whether it's the death benefit or the life insurance, are typically tax-free. Of course, consult with any tax thing. Consult your CPA and your specific policy. But as a general rule, we're talking 100% tax-free benefits. They're paid for with after-tax dollars, so it's kind of a fair trade-off there.
Yeah, exactly. And Drew, tell us about like a lot of these hybrid plans, most of them, in fact, are called cash indemnity. How does that benefit the clients from your experience?
Yeah. Cash indemnity is probably the best innovation in long-term care insurance that we've seen over the last 5 to 10 years. Every single company at this point has some form of cash indemnity. Some are stronger than others. But ultimately, what it means is that you're going to be able to receive just what it says, cash, what it says on the tin, as they say, cash benefits without having to submit receipts. It certainly varies a lot from company to company. Some of them are restrictive on a certain dollar amount or percentage. Some of them are completely unrestricted, like the Nationwide Care Matters 2 plan and a couple of others. Securian, Bright House have options like that. It's a great feature because we've talked to literally tens of thousands of people over the years. What's the number one complaint about like their parents' long-term care plans?
Yeah, it's having to submit receipts and talk to insurance companies. So, we realize that's going to be a friction point when you go to file a claim, especially imagine yourself 85, 90 years old, having to navigate these customer service. I mean, it's hard enough to do it right now. Imagine when you're 80 or 90 having to do it. So the less roadblocks you have to deal with and that you can take out of the equation, the better experience and the more ease of use when you go to use it later in life.
Yeah, and the best part about it is, these companies tend to be still price competitive, even with cash indemnity. Having said all of that, I actually have a traditional plan for my mom, which is a reimbursement, which is like the opposite of cash indemnity. And I don't lose any sleep at night over the fact that we'll have to submit receipts. So it's not the end of the world. If you can get indemnity and it doesn't cost you anything extra, it's the way to go, but it's not the end of the world if you can't.
To your point, yes, most people are going to have a traditional long-term care policy, and they've been paying claims. Billions of dollars of claims have been paid on those over the past 20 years. And that's what my parents had. My mom actually used her policy already, and it was with Genworth. It was a reimbursement plan. And there was a little bit of friction, but it wasn't anything that was too insurmountable. And it's also like, not everybody, we realize, we get it. Not everybody has, $100,000, $200,000 to put into one of these hybrid plans. So, but you still have the long-term care risk that you got to account for. And so that's where, just paying that monthly premium, that's going to be a lifesaver. Now, I did want to just, at LTC Tree, we just try to keep it real and really not oversell anything. And so a lot of this might actually be on our website, but we want to give some context to it. 70% was it 70% of people will need long-term care.
Yeah, once you hit age 65, it's a 70% chance you need long-term.
That's a very high, that's a very true, accurate number. But the context I want to give to people is that's of the general population. So that's where, you take everybody, no matter what their health is, average them out, it's 7 out of 10. But of the insured population, if you're watching this video, you're probably healthy enough to get it. Your risk is probably not going to be 30%. 70% would use it.
Might actually be 30%.
Yeah, it might be 30%. But we just want to keep that in context because that statistic, they're just looking at the people in general, but like of the insured population who exercises, low BMI, non-smokers, that your statistics is going to be down a little bit. And that's really important. The reason I bring that up is because when you're, long-term care, it's a risk management. We're talking about risk management. So you got to really figure out what is your risk? What's your real risk? Now, if you have one foot in the grave, you have diabetes, you're overweight, you had cancer last year, you have a high risk. So, but if you exercise, go to the gym a lot, low BMI, you have parents living into their 90s, your risk might be a little bit less. And so maybe you get a little bit smaller long-term care policy and self-insure a bigger portion. So we have solutions for for everybody, no matter what your risk profile is, no matter what your health profile is. And we have experience handling all types of different people. So, Drew, if people want to get in touch with us, talk with us, how do they do that?
Yeah, so we'll put our phone number on the screen and link it in the YouTube comments section. What we do is we compare multiple carriers side by side. So all the top policies on the market now, whether they have return of premium or not, will be on the comparison.
And I love the cameo. We just had one of your daughters popped in.
Yeah, she's popping
We're
in to get
LTC too. We're a family company. We encourage our kids to
I
to
thought that door
photobomb
was
us all the
locked,
time.
actually. Yeah, so anyway, we compare multiple companies side by side, whether it's return of premium or not. I would say most of our traditional plans, we do not recommend return of premium. If you're watching this and you're curious, we can certainly add a little box that says, here's what your premium is, here's what it costs with and without return of premium. It's easy to do.
Super simple, yeah.
All right, cool. We'll wrap it up. Thanks for watching this. If you're on our website right now on the return of premium page, click into YouTube, give us a comment, give us a question, or request a quote from us. We'll get right back to you.
All right. See you guys. Thanks.